one of the questions that often gets asked is what is the advantage of being in real estate based upon when the markets go up and when the markets go down. So like I told you before, I actually started in 2008. I call it being born in the crash. I was actually looking for deals before then, but the first deal I got was in 2008, and it was right at the beginning in our own local market in LaCrosse County, Wisconsin, of the crash. The crash really started in 2006, 2007, but we have a delay of getting to the Midwest. There was actually a map I saw a long time ago that showed how the effect of the economy coming apart and how it actually came in from the east and west coast all the way to the center on a time delay, and showed exactly the effect. It actually slows down when you get to the center of the country as far as the amount of cost reduction or price reduction or value reduction that occurs, and it takes about 1 to 2 years. So the canary in the coal mine, as I call it, which is the fastest market to get hit, is always Las Vegas, because Las Vegas is where people spend their luxury dollar, their bonus dollar. So the moment there's no bonus dollars, Vegas gets hit. After that, it normally was Arizona in 2008, 2006, 2007, 8 crash was Arizona, and then Florida. That has changed a little bit because Florida is now being run upon by people leaving New York. New York market and California market have consistently been very steady as far as no matter what happens, there's always demand in those markets. That is changing because of the political winds. Those states are having enough people leave them now that those states are weaker. But in general, the way the market looks is Vegas is the fastest that crashes. Arizona is second. Florida used to be third. Florida may not be anymore. But in general, those are the measures by which, if you study the entire United States, you can measure your own local market off of those markets. For LaCrosse County, it actually took 2 years for it really to get to us. And then like the market cap loss, meaning the amount of reduction in price across the average single family home in those markets, Vegas was somewhere between 55 and 60%. Arizona was around 50 to 55. Florida was 45 to 50%. LaCrosse County, where we work, was actually only a 10% market value loss in the entire crash. So we have a lot less crash, plus we have a 2-year delay. Knowing this for your own market, wherever you're working, studying those national markets as compared to your local market matters, because knowing that will actually help you prepare for the next time something happens. But the best part about it is you can actually see into the future as far as where you can see those value changes and then make adjustments. Most of the money is made, like real estate money is made when everybody is trying to sell at the same time versus everybody trying to buy. So it's best to have a lot of property when everybody's trying to buy, and it's best to be able to buy property when everybody's trying to sell. And so paying attention to that and understanding these markets matters. By the way, almost every market locally mirrors the national market, meaning in every market locally, there's always an area that is not crashing. It's usually called Snob Hill. It's where people want to live in that local market no matter what. Then there is a place that is staying pretty strong, and then there's a weaker place, and then there's what we call the war zone. The war zone usually is the one that crashes the hardest, because if there's any problems with amenities in an area, it ends up being like safety is the number one amenity. It ends up being the first place people sell when there's a crash. So with that, knowing your markets and understanding valuation really helps you be able to make the right appropriate moves when the markets change, and markets always change. Now, let's tie it to what happens in the stock market. Generally, the stock market is a canary in the coal mine to the actual real estate market. So the volatility you'll get in the stock market will then lead to what the volatility will be in the real estate market. The best news about that is it is also on a delay into the real estate market. So everybody right now is very concerned about the fact that this feels like we're in 2006 again. The major difference between 2006 and today is that we have a shortage of inventory that we've never seen since basically the 1950s, when all the GIs came back from the war. That shortage alone is the main driver that changes what happened in 2006 and to what is happening right now. That doesn't mean we're not going to get some fluctuations in markets, but in my view, this is all being driven by political interest and big investors. These big investors want the turbulence because they make their money in the turbulence. They want the stock market to go like this because they make more money in the turbulence than they do if the market is just steadily gaining. Whereas the long-term investor makes more money in the steadily gaining, so they want you, the small investor, to be afraid every single day. Now, the advantage of investing in real estate with us is if the stock market is going like this, the deal that you do with us is still growing because you're getting paid a rate of return on the capital that you put with us. So that's one of the hugest advantages with us. Feel free to reach out to me either through this email or you can call me on my cell phone at 608-306-1199 to get more information about what those advantages are. With that, I hope you're having a great day and we'll talk to you soon.